Hello, welcome to today's StockRanks webinar. I hope that everybody can hear me. We're going to get started right away. My name's Ed Pagecroft. I'm co-founder of Stockopedia.com. I'm going to be the host for the next hour. We will be covering a lot of ground over about a 45-minute period with a 15-minute period at the end for Q&A. This webinar will be recorded and online on our YouTube channel within a couple of days max. So don't worry if you miss a bit. If anybody can't hear me, please do say now. Great. Okay, well, on the agenda today, we're going to be talking about the stock ranks. And this is a very different webinar to the ones we've done before. And hopefully it will be quite revelatory. On the cards today, I'll be introducing the stock ranks. I won't be presuming too much knowledge about them before, but this is aimed at all levels. We'll be explaining what the ranks are, looking a little bit at the philosophy and construction and some of the backtest results. And then once we've gone through that, we will talk about the performance since launch. We'll be looking at the decile returns. We'll be looking at what we call the StockRank Crossovers. We'll look at random portfolios that have been constructed with high-ranking stocks. And we'll also look at some external validation of the methods in the Mechanical Bull blog. I'll then show you how you can find these high-ranking stocks on the website and looking at stock reports, screens, ranking lists, and table views. And we'll talk a little bit about the risks of these systems too, and then followed by Q&A. So before we get started, I must say this disclaimer. We've obviously done everything we can to audit these results that we'll be showing, but the statistics could be subject to errors. It's really vitally important to do your own research in the market. We are not a regulated service and we provide no recommendations to buy or sell securities and nor of their suitability for subscribers. So please do take independent financial advice before making investments. Most importantly, obviously, past performance, of which there's a lot shown in this webinar, is not an indicator of future results. I do not have a crystal ball, but it could be possible. The last 5 years, they have shown great returns for stock investors, and the next 5 years could be a lot more moderate. So please, DYOR, as we like to say on the blogs. So firstly, what are the stock ranks? Well, this really is a simple system. It's designed to help individuals make better decisions in the stock market. And in cutting to the mustard, in very practical terms, they are 4 numbers on a Stockopedia stock report. So if you are not a subscriber, you may not be familiar with the Stockopedia stock report, but this page shows a lot of statistics on stocks, and this is just a fraction of it up at the top. A lot of people are intimidated by financial statistics. And what we've done is build this stock ranking system right up here, which shows the value, quality, and momentum ranks for a stock, as well as what we call the overall stock rank. We rank all stocks from 0 being worst to 100 being best across each of these measures. So for the value rank, the cheapest stocks would rank above 90. The most expensive would be below 10. For the quality rank, the good, safe, improving stocks would be above 90, while the speculative junk would rank below 10. Similarly, for momentum, stocks beating expectations with rising share prices will rank above 90, with the opposite below 10. So the overall stock rank is a blend of these approaches, and it shows good, cheap, improving stocks will rank highly. We rank 2,000 stocks in the UK, 8,000 across Europe, and we'll be including the USA and Canada within a couple of months. So in our editorial, we talk a lot about QVM, which is really our acronym for quality plus value plus momentum. And it's really designed around our ranking systems. So you can see them up at the top there. We've put together this Venn diagram because it really shows how this all locks together. The reason we focus on value is because value investing works over the long term. Cheap stocks beat expensive stocks. Quality stocks tend to beat junk stocks. And also momentum stocks tend to beat winning stocks that have won recently tend to beat losers. And right in the middle of that, you find the stock rank, which is right at that intersection of all three. Now, if anyone's in a hurry and they want to see some of the results that I've been promising for a while, I'm going to be going into these in a lot more detail a little bit later, because we've got a whole portal that shows and generates these results. But you can see in this list that from the first initiation of the ranks, the very top scoring ranks, according to that blended approach, have returned almost 38% in just over a year. And those are the whole basket of stocks which were ranked above 90. There have been even more impressive results for the top 1% of stocks, and this has proven to be quite robust to market cap and sectors too over the last year. So I like to say serendipity has had the good grace to give us these results, because frankly, I wasn't expecting to see this kind of thing in the very first year. And they've very much beaten the guru screens as well, which we became quite renowned for to begin with. Now, next, before we go into showing you the portal and more of these results and showing you how to find them on the site, I want to talk a little bit about how we've constructed these stock ranks. I'm not going to go very much into the philosophy of how we've done this. We've discussed this before, and we will be sharing some further reading links later on in the webinar. A lot of the academics would like to, a lot of academic research shows that to some extent, stock prices are explainable, almost predictable. And our stock ranks are really based upon this academic kind of framework for thinking about stocks. And in the academia, you would find value, quality, and momentum are very key factors in in stock understanding stock returns. And there's a lineage that comes through lots of the kind of literature that's on our bookshelf, but also a lot of the academic papers. But first of all, let's talk about the value rank, because people generally understand value investing. Cheap stocks beat expensive stocks, although they don't year to year. Sometimes they can go 2 or 3 years without outperforming expensive stocks, but people tend to pay too much for expensive stocks. So how do you measure cheapness? Really, you can measure cheapness in a couple of ways. Firstly, you could compare a company's share price against what it earns. And there are various measures of what a company earns. You could look at the P/E ratio. You could look at the earnings yield. You can look at the free cash flow, price to free cash flow, and you could look at the dividend yield. You can also compare a company with what it owns. Generally, people will look at the equity value, the book value of a stock. We use the price to book ratio in the value rank. And there are obviously other measures for valuing companies. There are lots of them, almost an infinite array of them. But another one that is very popular for companies that don't have earnings is the price to sales. And it can be a very effective measure for valuing stocks. And what we do in the value rank is we try and turn each of these ratios, which you get a score and a metric for every company in the market. I'm sure everyone's familiar with the PE ratio for every stock. But we try and turn these numbers into rankings. So, for example, if you have a PE ratio, our goal is to turn its PE ratio into a rank, a percentile rank from 0, which is worst, to 100, which is best. And for a company, let's say, that has a very cheap PE ratio of, say, 3.2, we would put that in order of all the other stocks in the universe and find out where it ranks from 0, expensive, to 100, cheapest. So for this stock, it might be cheaper than 94% of stocks by the PE ratio. If you look at another one on a more average PE, actually this is a bit above average, it would be cheaper than only 42% of the stocks in the market. Whereas if we look at one that's really expensive, like an ASOS or something like that, on a P ratio of 67, you'd find that actually it's cheaper than only 4% of stocks in the market. So in other words, it's very, very expensive. So we come up with this number between 0 and 100, which shows the percentile rank of a stock's ratio. And what we do to create the value rank is very simple. We take these percentage scores for each of these common ratios that we discussed: the price earnings ratio, the price to free cash flow ratio, the dividend yield, the earnings yield, the price to book ratio, and the price to sales ratio. And we sum all those percentage rankings into an overall score, and then we re-rank it again from 0 to 100 to come up with what we call the value rank composite. In this case, the value rank becomes 57 out of 100. Nothing to write home about, but not expensive. And And really, if you do a long-term back test, and this is one we did on a US universe of stocks, it does very well. And this is something that has written about extensively in James O'Shaughnessy's What Works on Wall Street, which is a terrific book. And he creates several different value composites like this and shows that they have this kind of clean relationship between where cheap stocks do better than expensive stocks. One of the reasons this does so well is that different ratios come into fashion at different times. For example, lately, the dividend yield has been very popular, but the price to sales was the only ratio that worked in 1999. And all through those years in the noughties, price to cash flow measures were very, very popular because private equity was in the game. Using a blended composite rank to create this value rank actually is very effective because it ends up with better returns at lower volatility. It kind of smooths out the ripples that people might just use if they only use something like the P ratio on its own. So it's quite descriptive and very useful. Let's go on to talk about the quality rank. Quality stocks outperform junk stocks. Essentially, this means that companies that generate capital tend to outperform companies that eat capital. But good shares can often be very expensive. And currently, the really good shares can be very well priced. So let's have a look at how we assess quality. Firstly, we look at what we might call the franchise factor, which is something Warren Buffett might look at. Is it a good company? And to do this, we look at 5-year average profitability, return on capital, free cash flow of a company to see if it's a strong company. We also look at the stability of the margins and the growth rates. We don't necessarily look so much at the current face value of the return on capital, return on equity, because it's often companies that are displaying very good current metrics are often very, very well and keenly priced. We also look at, for about 30 or 35% of this measure, on the direction. Is it an improving stock? Are the fundamentals of this stock improving? And we use something called the Piotrowski F-score, which many subscribers will be aware of, which is a 9-point checklist of fundamental health. Finally, we look at the risk. Is it safe? Is there a bankruptcy risk? Is it highly geared? And what is the earnings quality like? Earnings quality is a very important measure, which can, we use something called the M-score on the site. But people might have seen Blur Group in recent weeks, which has had some profit warnings because of very poor earnings quality and aggressive revenue recognition. These kind of forensics are difficult to calculate, and we calculate them all for you. Finally, one of the things about the quality rank are the goals with this. We've tried to make this predictive, not descriptive. This is important to understand. We've focused on predictive measures for stock returns, rather than, say, just describing the best companies in the market, because you might end up with a list of just FTSE 250 companies. And the point is to try and find the factors of quality which are most predictive. And this is something that all the academics are very much focusing on at the moment. And really the idea is to find the good, safe stocks with improving fundamentals rather than bad, deteriorating junk. Again, on a long-term back test, we see that these kind of better stocks generally beat the riskier ones, but obviously not the very top quality stocks don't outperform just as much as you might expect. So let's look at the momentum rank. Now, this is something that not many people use or understand. In fact, in our recent survey, only very few subscribers use momentum in their investing, but it's something we're quite keen on here. Past winners have a tendency to beat past losers. People hate buying stocks at new highs, and for that reason, they're often underbought. A classic example is when David Stevenson, fantastic journalist at the FT, he wrote something about stocks that got away, and this was written in February 2013 last year about Dart Group, which I'm sure that many subscribers know very well because it's been highly ranked and on the screen of screens for a very long time. He wrote this article in which he mentioned you could have found it on the screen of screens on Stockopedia. But he says here, this is one that got away. One of my big regrets was not buying into this UK transport group called Dart Group. Sadly, I found more interesting stories to chase and I let it get away only to watch in horror as the price more than doubled. Of course, he wrote this when back in 2013 at the point of this star on this chart. And since then, the share price has doubled again. And it's a classic example of why momentum works. We're always scared of buying shares that have gone up in price. And what everyone should realize is that all the other investors in the universe are scared of buying shares that go up in price. So often shares don't go up enough in price. And this is how momentum works. There's a behavioral reason trends tend to persist. Now, how do we build the momentum rank on Stockopedia? Firstly, we look at what is called price momentum. Essentially, this is by how much is a share price beating the market. It seems crazy, really, but proximity to a 52-week highs and the relative strength of a share price are very much sort of proven to be slightly predictive of future stock market returns. This tends to work best over 6-month, 1-year periods. And it's been hugely studied by academia. And in fact, momentum has been shown to have even more of an impact on share prices than the value effect, although value investors wouldn't like to admit that. Secondly, earnings momentum is another part of our momentum rank. This is maybe more understandable for a lot of investors. Are company earnings beating market expectations? Companies that beat expectations tend to keep beating expectations. We measure this by looking at broker profit upgrades, forecast upgrades. We look at profit surprises in the market when a company beats expectations, and also recommendation changes on stocks. And this all comes together in our momentum rank. And again, we performed a back test on this in the US universe to try and make sure that our ranking was nice and robust. And we put all this together. And again, here's the Venn diagram we're quite you're probably familiar with. And we put all those ranks together to come up with our stock rank, which sits at the center of all those 3 rankings. And generally, what are we trying to do here? Well, we're trying to find the best stocks in the market. We're trying to find cheap, good, improving stocks. It's a very sound framework for finding good stocks that might beat the market and has a very good lineage. So cheap, good, improving, you'll see us writing about a lot on the site. What's the opposite? Who wouldn't want to buy cheap, good, improving stocks? If you look at the opposite category of stocks, you might call them expensive, deteriorating junk. Now, it's very hard, rationally, one would prefer a certain category of stocks to another. And that's really what we're trying to do in the stock ranks. So now that we've been through this, just a couple of important points. Our ranking system is purely quantitative. I had a question from a subscriber recently who was couldn't believe that we didn't have a qualitative input in our ranking on stocks. We don't put out buy ratings. We're not putting out recommendations on stocks. We're just putting together numbers that we believe work in the stock market and putting them available to subscribers. There's no qualitative assessment in the rankings. They're purely using the numbers. And these are designed as probabilistic rankings. Just because a stock is ranked 95, 2 stocks ranked 95 can have massively divergent returns in the stock market. So you must expect there to be a lot of idiosyncratic volatility in stocks. These things are best used in a portfolio approach rather than in stock picking. So let's go on and have a little look at the StockRank Performance. Now, we've built this portal on the website which shows which lets us build up some back tests. Now, this is not available to subscribers yet, but I'm hoping we can put it out there at some point. This line you'll see here is the FTSE All Share since we launched the ranks in April last year, and it's been up about 10.3% altogether. If we now switch on, we're looking at a universe of stocks, and we're looking at all the stocks above a 10 million market cap. We've cut out about half of the market lower than 10 million market cap because they are micro caps and they can be quite volatile, but actually the results hold up amongst them just as well as they do above larger stocks. But I wanted to present results which were investable by private investors without too big spreads. If we look at the top 10%, according to the stock rank, it's returned over the last year about that whole basket, which has 134 stocks in it, returned about 38%. If we look at the very bottom ranked set, of which there are 63 stocks in it, they returned a negative 12%. The reason there are less stocks in the bottom set than in the top set is because there are more low-ranked stocks amongst 10 million and lower market caps. Now, if we go down through the rankings one by one, and we look at the 80 to 90 stocks, the stocks ranked 70 to 80, start seeing a sort of linear relationship. It doesn't hold perfectly. 60 to 70, stock rank 50 to 60, 40 to 50, 30 to 40, 20 to 30, and 10 to 20, which actually were the worst performing set in this test. And you can see that there has been this relationship of stock returns. And I think this is what certainly I wasn't expecting this to come through quite so well in the very first year. I'd have expected these results more over longer term. So maybe we could have got lucky. So the important thing to take away is that higher ranked stocks have had a tendency to perform better. Now, if you look at this this table here underneath, you'll see that each of the buckets, 190, 80, all the way down to the bottom bucket, we've got percentages of how many have reached more than a certain bar. So on this line, the percent that have gone better than 10% over this time period, the hit rate in the top decile, the top 10% of ranked stocks, was 85%. 85% of those stocks beat the market. In the very bottom bucket, only 22% beat the market. 2 lines down, the percent that got a greater than a 50% return, there were 31%, almost a third of stocks in the top 10% of our ranking system got more than a 50% return in this period, which is just over a year. In the bottom set, there was only a 1 in 10 chance. And I always like to say you've got to fish in the right pool in the market to try and beat the market. And I think this ranking system, I hope going forwards as well as in the past, will help investors to do that. It's a very rational system. Now, obviously, these results that we've had in the last year, the past performance, no indicator of future results. But I think it really does explain. But I think it still shows the sort of the method really has worked extremely well at ranking the market. Now, let's quickly look at some of the other dates, because this is one portfolio of those stocks held over for that year. And we've got a couple of other sets set up. We don't have any rebalancing in these tests at the moment. So these are just different sets chosen at regular intervals through the last year. These are the ones from June last year over about a 1 year period. Again, the top set has returned about 33% over just under 12 months. If we look since last September, again, if we wait for the results to come in, the top ranked stocks, again, almost up at still the top performers, got beaten by the 60 to 70 group there. And if we look at them since the start of the year, when returns generally have been a lot leaner all round, again, you find that those top ranked stocks, 80 to 90 and 90 to 100, have done best. So this is mapping the market quite well as a ranking system, and I hope is very, very useful. What happens, though, when we look at larger caps? Well, obviously, there are a lot less stocks in larger cap groups, but let's look at all the stocks that in quintiles, because it gets noisier as there are less stocks in each set. And look at all the stocks above $1 billion. Sorry, let me put this back from April last year and look at all the quintiles since that period last year. And you can see that the top 20% of stocks above $1 billion, there are 77 stocks in this bucket, returned 21%, nearly double the market. So this does work, has been working amongst larger caps as well as amongst small caps. Now, the danger for this obviously is hubris. Have we cracked the stock market code? Of course not. This is based upon sort of decades of investment thinking. We're very much on the shoulders of giants here. Robert Haugen, who's a real legend in my book that not many people know about, called stocks of these kind of profile super stocks. And at the opposite end, he called them stupid stocks. And but I think we are kind of showing there is this spread between these two different classes of stocks. And I don't know, obviously these things break down. Some years you're going to see the lower ranked stocks are going to come firing back. In these buckets of lower ranked stocks, by the way, you will find a lot of stocks which you would not really like. And before I go and look at the top 1% results, let's have a little look at some of the results. If we go down here, in this stock performance table, you can see the lists of stocks and some very familiar names that have done very, very well in each bracket. Some of the top stocks in the last year: JD Sports, Staffline, Traxys, Dark Group, Renew Holdings at the top. If you look in the very bottom bucket, you'll see, yes, some have done very well, Nighthawk Energy and Tower Resources, but there are also a huge tail of stocks that have done abysmally. But you'll see that there are a lot of resources stocks, a lot of oil stocks. And I think our system has certainly probably been lucky this year in that a lot of these sectors have done quite badly over the last year. And when those sectors do come shooting back, we might see a reversal. But what about the top 1% of the market? Because I know I get a lot of feedback from subscribers, and it's always made me very nervous looking at people just firing straight into the top 99 and above bracket, because there are only in the UK 20 stocks in this bucket. And, because there are just under 2,000 stocks in the UK market, there's only about 20 stocks in the very top StockRank bucket. But you can see that since that beginning of the test, they've returned almost 45%. And if I scroll down, you can see in this list some of the very familiar names: Dark Group, Staffline, stocks like PhotoMe. Now, these are not necessarily stocks that you would have bought last year. And this is a point about the system, that it does find stocks that, are not the glamour names in the market. These are often very ignored names. In this list, you can see PhotoMe and Pace, who makes set-top boxes, and UK Mail. These are not the stocks which are the glamour stocks, which, of course, tend to be too expensive and don't do so well. So that's always worth looking at. The other thing to look at here is if we look at the components of the quality, value, and momentum score, the overall stock rank, they haven't done as well as the blended approach. And that's a very important thing to bear in mind. And obviously, the key thing to also look at is the variability of the return. These were all ranked 99, but in this list, we've got returns from 130% positive to minus 10% negative. So anybody using the stock rank should not think that a certain ranking leads to a certain return. It leads to a very wide variability of return. And I'm going to go and look at some random portfolios very, very shortly. But look, the criticism of something like this system might be that how do you pick an ASOS with this sort of system? How would you pick utility-wise some of those stocks that have been, are really great companies that have done really, really well in the market? And we do actually have an answer to this. And we have something that we call the StockRank Crossovers. And if we go back to look at some of these value and quality Venn diagrams, this crossover in the middle between value and quality is where you might find good, cheap shares. Warren Buffett would say he likes buying quality merchandise when it's been marked down. And value investors often like to fish in this sort of area. Warren Buffett, Neil Woodford, John Lee, people like this is where they like to fish: good quality, cheap shares. And finding those kind of shares, we've created something we call the QV rank. QV standing for quality plus value. And that's a very good way for value investors who want to steer clear of momentum to use this system. But then if we overlay the momentum circle as well, you can see on the right here, there is that interlacing segment between quality and momentum, where Bill O'Neill would like to say he only likes to buy market leaders. And his strategy in his book, which is called the Can Slim approach, it completely ignores P ratios, and it's very happy to buy companies on a P ratio of 50 plus. Now, the thing is, this kind of strategy can work. The Can Slim screen on Stockopedia has done exceptionally well. You find that this is a key part of nimble traders like Richard Dryhouse, Mark Minervini. They are completely ambivalent to value. And we've created something called the QM rank, which also performs very, very well, which is dissociated from value at all whatsoever. And on the other side, where I always write a lot about value and momentum, it's one of my favorite strategies. It's a favorite strategy of James O'Shaughnessy and lots of academics and quants. And there's the VM rank there, VM standing for value and momentum. And in the middle, obviously, we have the QVM stock rank. So that's enough of that. But really, when you're using the ranking systems, you should be thinking what type of investing style best fits your psychology. Are you a value investor? Do you want to use momentum or not? Because it really is about what you're comfortable with. You should be having a strategy that you can stick with through thick and thin, rather than something that you might sort of willy-nilly just sort of jump in and out of. Anyway, let's go back to the portal and look at the QV. Let's have a look at the quality and momentum list, because this is very, very interesting. If we look at the QM rank, and we submit this, with any luck, we'll get a list of stocks. And we can see the QM rank has done almost as well as the normal stock rank, 35% over the last year. And these are stocks with which are not necessarily cheap. And at the top there, you'll see some of these more glamour names. Utility-wise, you'll see there. You can find stocks like Judges Scientific. Looking down the list, there's ZAR, there's Supergroup, stocks that have returned 65% plus. Delcam, you can see also Ted Baker and Asos and stocks like this down there. So don't think that this ranking system is just for people that like trying to find the cheapest stocks. You can use this in very creative ways. Now, this is all very well, but what happens if somebody throws darts at the market? I know that a lot of people know about the whole monkey with a pin approach. Now, if you were to throw at a 3-stock portfolio at the highest ranked stocks, you would see a very, very variable return. 3-stock portfolios are not very sensible. And you can see here, if you looked at 90 plus stocks and just tried to buy 3 shares, you would have had returns of anywhere between 5% and 83%. Let's just put some filters on here. Look at 20 million market cap plus companies and look at slightly more diversifying our portfolios, and look at random portfolios that random 10-stock portfolios, and we generate the results. Again, you can see here 90 plus, there is still a variability of return between 17% and 58% across 15 10-stock portfolios, still doing better than the market. Now, if we put the rating up a bit to 95 and we start looking at 15-stock portfolios, and we always say people should have at least 15 stocks in their portfolio if they're using this kind of approach in the market. But what you start seeing is that you end up with less variability in each portfolio. And if you got lucky in this, every time you generate this report, you'll see different results. Sometimes you can see portfolios that have returned more than 70%. Sometimes only 25%. But in the last year, they have consistently beaten the market. And at a certain level of diversification, you would have ended up with the returns that are more like the entire large bucket of 90% plus ranked stocks. So I think that is very interesting. But of course, one of the things that's important for us all to understand is that when you're using these ranks, if you're looking at high ranked stocks, there are a lot of people on this call. We've got nearly 300 people, and I would expect there's going to be 500 plus people, or maybe thousands, watching this video on YouTube afterwards. And if everybody goes out and just starts looking at 99 ranked stocks, there's only 20 in the market. So one has to be careful when using ranking systems that there can be crowding in trades. So be careful if you are using these systems, and be mindful of your approach. Obviously, do your own research. Never invest blindly in the stock market. You should research all the stocks that you invest in and take investment advice. We are not an advisory service, and I must reiterate that. And there's no guarantee that these kind of performances or results can possibly be continued in the future. We're just trying to create a rational approach to the market. So anyway, let's look a little bit about how you might find these kind of shares on Stockopedia, and move away from this portal of stocks. Let's go on to the home page, and I'll show you. If you go down the page past the Guru Screen section, you will see a StockRank section here in the middle. You'll find some links to the guide. We've got a guide for this, and actually I'll send an email with lots of links to some of the things we're talking about today in an email after the webinar. But you'll also see a sort of brief top 10 across some of these ranking systems, these composite ranks. We haven't talked about the growth rank yet. Don't have time today, but we can go into that in another session. It's not used in our core ranking system, mainly because growth is very correlated with quality and momentum. And it doesn't work as well. But if you were to click any of these links here, for example, looking at the top 10 value rank stocks, if you click it, you will go through to a list which is also accessible under the home menu, the second link down, clicking Browse Ranks. In this page, you'll see on the left a section called StockRanks, and you can find the very highest ranked stocks by clicking any of these links. You'll see a list of the stocks and their tickers, their market cap and price changes on the day. And you'll see in the list on the right, the stock rank. And there are some simple filters here for looking for large caps, mid caps, small caps, and micro caps. So you can dig around there and find the higher ranking stocks. There's also the basic ranks, quality, value, and momentum, and growth ranks here. And underneath, you'll find some of those crossovers we were talking about. I've honed in on that QM rank, quality and momentum. And in these lists, obviously, you can find all kinds of different types of stocks. Now, what if you wanted to screen the market for the stock ranks? Because a lot of people use the stock ranks as well as using more standard ratios like the P ratio, like the dividend yield, etc. A quick way to get started in screening is to go back to the homepage, scroll down, and you'll see a little box here that says StockRank Screening Recipes. These are all different screening recipes that are set up across the different crossovers and the main stock rank. So if you wanted to find mid-cap stocks with quality, value, and momentum, you'd click it and you'd go through and you'd see the list. This is obviously one of my screens, but you can fork it by clicking this button on the right and create your own stock screen. I've actually logged in as completely the wrong person. So let me log out and go back and log in as a guest. Bear with me. I knew I was going to do that. And oh no, I can't remember the password. Having all things gone so smoothly. Okay, there we are. Let's go back to the home page and we will go back to the ranks and look at mid caps, QVM mid caps. Now, again, if you fork it, click fork on the top right, you'll get taken through. And with any luck, yes, you'll see the screening rules. And you can see here that we've set this up to look for certain types of stocks. If you're in this list of ratios, when you are adding a ratio, you can just scroll down and you'll see a whole section here with the stock ranks, the overall stock rank, quality, value, momentum rank. And obviously you can construct these screens any way you like. So let's just have a little look for, let's just build a little screen here. Let's call this a test screen. And we've got a market cap rule in there. That's fine. Let's look firstly for, we want to find cheap stocks. So you'd look for the value rank and we want to find cheap stocks. Let's look for the top 15% cheapest stocks in the market. We also want to add in another factor. You might want to add in the stock rank. And so put in the stock rank and look for stocks that have got a stock rank of greater than 90, but that are also very cheap. In fact, let's make it even cheaper because obviously this will cut down the number of stocks with a high stock rank even more. This is showing mid caps, which have a lot of which are in that profile. And there's lots of things we can do with these stock ranks. We can obviously also add dividend yields. Let's look for companies that have got a yield of more than 3%. Let's loosen these criteria. And you can play around with the kind of stocks that you might find and look for, use this any way you like. Obviously, in these tables, you've got different table views. One that everybody should look at is this one, which is the second along here, called the ranks. Any table on the website that you've got, you can click the ranks table and you'll have this preloaded set of stock ranks all in the view already. If you click each of these stock ranks, you'll also get a pop-up which shows you the breakdown of the stock rankings for each one of these metrics. Very good and very useful to know. Also, if you want to change these views, of course you can. If you prefer, you can click the edit button and bring up the table editor, which you can then move things around. Let's say you wanted to move things around, you can drag things around and use other ratios and metrics from the library. But we won't do that yet. We won't do that now. The other thing to be aware of is this little section of gray buttons on the top. The very one on the far right creates what we call the bubble charts. And these bubble charts are a really great visualization of the kind of stocks in any portfolio or basket. Now, if I just pull those off, you'll see this has got two axes. It's got the value rank on one axis going from expensive to cheap, and it's got the quality rank on another from junk to good. And in that, all those charts we've seen, those kind of expensive junk stocks have tended to underperform, and good cheap stocks have a tendency to outperform. And so when we're ranking the market, we're seeing that this screen has actually is generally finding those good cheap stocks as we would expect. If we'd done, if you look at any of the screening strategies on the website, you can check them for this, or you can check your own portfolios. And I'll just quickly show you that, because a lot of people are very, find certain some of these strategies are very popular. For example, the Jim Slater Zulu Principle screen. Click the link. We can go through, view the results. With any luck, they'll be there. Yes, they are. 21 stocks in the UK. And on this view, you can see all of Slater's screen strategies. You can click the ranks tab, like I showed you, and see all the stock ranks in the view. Again, on the top right, you'll find a little button there which changes the view into the bubble charts. And because this screen is not built by any by any of the ranking systems, you'll see they're spread a lot more towards quality stocks and actually more towards expensive stocks. If you click some of these other tabs at the top, though, you can look at change the two axes to one of the other ranks. And this shows that the Zulu Principle screen is generally picking up quality and momentum more than it is picking up quality versus value. And it's a very interesting way of looking at stocks. If you look at your own portfolio and find that you've mostly got stocks in this area of the market, you might want to have a rethink about portfolio construction. Obviously, do your own research, etc. Please seek investment advice. And the other thing to be very aware of is this terrific screen about the bubble charts that we put together for the UK Investor Show. These are the top 100 stocks on bulletin boards in the UK. When you're buying stocks that are being highly discussed on some of the major discussion boards, you will find that they generally are lower quality, expensive stocks and this is one of the reasons why most private investors underperform. So that's all I really wanted to sort of talk about. And it's taken me through to about 12 past 1, slightly ahead of schedule. I've got a couple of slides left, which I can show you. One of my favorite academics is called Robert Novi Marx. This is a great quote from him. Over time, tilts towards value, momentum, and profitability have outperformed the market. A combined portfolio of these three has provided much higher reward with a significant reduction in extreme risk. And this is very much the basis of our ranking system. Value and momentum tend to slightly counter each other, and one might find that putting portfolios together in this way should have less volatility, but obviously not if every Stockopedia subscriber starts following them to the letter. There's some additional material here. If you want to further understand stock ranking systems and understand where our thinking has come from, here's some accessible books. I always say The Little Book That Beats the Market is a really great book. It's something you can even give to teenagers. It's only 120 pages long. It's a terrific book that really focuses on what we've been talking about as QV, quality plus value. Then What Works on Wall Street, another great book, should be on all keen stock market investors' bookshelves. It's filled with statistics. And in the fourth edition, very specifically the fourth edition, he goes over the value composite with some incredibly compelling results. And that really inspired the development of our own value rank and our other ranks as well. If you want to take something more advanced and more for the geeks, there's this great book called The Inefficient Stock Market by Robert Haugen. Again, very influential for a lot of the work that we're doing. He focuses much more on the QVM approach. He doesn't call it that, but it's got some terrific chapters in it. For those who like academic papers, sorry, this is really for the geeks only. Here are 3 slides. I will actually send this out and these links on an email to everybody. But Novi Marx's paper is terrific. Buffett's Alpha is a terrific paper as well. If anybody can deal with getting through this kind of academic prose, please give it a go. But it's hard going. I tend to encourage people to sort of read the intros and the conclusions and then look at the charts if you don't like reading all the text or understand what people are talking about. And the other paper is Value and Momentum Everywhere. Cliff Asness of AQR Capital was one of the first to identify momentum as this really significant force in the stock market. And a lot of their research at their huge hedge fund goes into the combined benefits of value and momentum. If anybody is still hanging around and wants to join Stockopedia, we have a £50 off voucher here, StockRank 064. Which if you sign up after this webinar, you can take advantage of. Also, there is a European discount code EU054. And I think that's pretty much it. So I was going to invite everybody to ask some questions if I've got 15 minutes. So I'm just going to run through some of these. And bear with me. Are we including intangibles in the price to book value in the value rank? I don't. We have price to book excluding intangibles. I would have to double check in the definitions in our library. I believe that we are using intangibles in book value at present. I will have to double check. The earnings yield. It's like the PE. That's somebody asking about a couple of questions about how we've composed the value rank. The earnings yield, which is EY here, it's actually the definition we use is the operating earnings divided by the enterprise value. Sorry if this is geek terminology, but it is similar to the price earnings ratio, but it takes all the company's debt into account as well. So it's really earnings to all stakeholders rather than earnings just to shareholders. Let's see. No, again, if we're using the earnings yield and the P ratio, no, for that, what I'm talking about, it's actually because the earnings yield definition we use, it is actually, it's looking at all stakeholders of the company. It incorporates the debt. So it is different. Why price to free cash flow and not price to cash flow? Well, price to free, that's a good question. And actually, you can compose this in different ways. We could do it as price to operating cash flow. We chose price to free cash flow because it has been thoroughly back tested, and we found that it was more effective. Obviously, free cash flow is available to the firm to do whatever it wants with, whereas operating cash flow would have to pay off other items in the cash flow statement. So free cash flow is obviously more available to shareholders and the firm itself. The stock data, just to look at some of these. Are there cases of the measure of the three ranks being in conflict? That's a very good question. Good for value does make it bad for momentum. You're absolutely right. What you would find, so let me just show you, for example, on the homepage. Of course, they can be in conflict, but you do find that cheap stocks in recovery, can score well for momentum because momentum works on a more recent time frame. The value effect really works over a sort of a 2-year period best, 2 or 3 year period best, whereas the momentum effect works more on a 6 months to 1 year period. And so what really the sort of the QVM approach is more a sort of annual rebalancing kind of approach. And yes, of course, there are certain stocks that are where the value and momentum are in sort of conflict. But a good way of looking at this is to look at all the VM scores. So on this homepage, you can see here value and momentum. If we look at the kinds of stocks VM on this page, and we look at the charts, we might find that generally, if I can look at like long charts, 3-year or 10-year charts, we probably would see that a lot of these are still like lower or a lot lower than their historic highs. So these are 10-year charts, and you can see sometimes stocks are still well below their highs of previous years. Cello, Creston, Carillion, a lot of these stocks still well down. There's and so you often find that this finds as Empresaria value stocks that are in recovery. Cambria is one which is ranking very highly on our system, Cambria Automobiles, and that's still not to reach its highs. So value momentum, these can still be cheap, but they've got strong recent momentum. So yes, good question though. Why didn't you use UK or European stocks for QVM backtests? Oh, we didn't use UK or European stocks for QVM backtests because we didn't have the database that goes back. But obviously we're live tracking this stuff now. We've only tested, I should have clarified that those stock ranks were very much on the UK market that I showed. They are not on European stocks. We will be putting those out later. Are we showing fixed portfolios picked from the start date, or are they percentile groups traded over the period? Yes, they were fixed portfolios, as I said. No, there are no trading costs accounted for. As I said, there's no rebalancing in these portfolios. And I think as I was saying, this is kind of a one-year approach. So I think it's appropriate to show just the 1 year held portfolio. Trading costs are not accounted for. Even if one was to take a 1% spread for transaction costs, etc., it would still be have been an effective approach. Please, can we send copies of the presentations? Yeah, we'll see if we can. Let me just see the next question. Hi, Todd Wenning. When we sum up the separate metrics to determine the stock ranks, are the metrics equal weighted or are there more weight put on certain metrics? That's a very good question. And I won't say exactly how we do it. Generally, for the value rank, from my yes, the value rank is pretty much equally weighted, although we do have certain there are certain conditions, though, because obviously a lot of companies do not have earnings or cash flow, and we do not cripple those. If company, for example, just you've only got a price to sales and a price to book value, those will be used. And from memory, I would have to check, and but I believe we're not including the earnings measures in the ranking factor. So if something's very cheap on a book value measure but doesn't have earnings, it can still have a good value rank. And similarly, a lot of stocks will not have broker momentum. So when we're putting together price momentum and earnings momentum, in this case, if a company does not have any broker numbers or forecasts, we take a score of 50. And so it will be used, we take a score of 50 for the earnings momentum, and then the price momentum will shift above and below that. So yes, there are different ways we configure it. And the one that we take more care over is the quality rank, which we do get a lot of feedback about, because sometimes people are very surprised by stocks that rank highly, because often they can have quite low returns on capital, because this is very much a multi-factor approach, and it heavily weights things like the F-score. As we mentioned, it really is a rank that is designed to be sort of, we've designed it according to the academic literature to be more predictive than descriptive. How do we introduce a timing element? That will be to come in future. We will be trying to add in, for example, on more strategy-based things in a later date, but that's not really for this webinar. The US version, we're hoping, will be available next month. Stock ranks are updated every single day, Rebecca. We update them absolutely every day. This morning, the results came out at 5:30 a.m. We're hoping that because we've changed our back-end process in recent weeks, that things will be updated from about 5:30 daily. So yes, they're daily. I'm hoping that maybe next year we can get to hourly computes, which would mean the ranks would update throughout the day. So for companies that move a lot in share price, it would be nice to see updated ranks. How quickly are the ranks updated after a trading statement? Well, there is a lag from the trading statement coming out to when we get the numbers. We're actually working on quite hard with Thomson Reuters to improve the timeliness of the reporting. Obviously, it doesn't come out the next day. We do have all pan-European stocks, but we generally find that the very largest stocks get their numbers updated quite quickly after finals and after trading statements and interims and quarterlies, but it can take a bit longer for it to come through for the very small caps. Sometimes I've seen micro caps which have taken up to a month for the numbers to get out. Now, what Thomson Reuters have put in place is a process which feeds in the fundamentals much more quickly to us using what is called sort of a slightly semi-automated systems. So we will be putting and integrating these in within the next few weeks, I'm hoping. So it's going to get more and more and more timely. When and how would we suggest rebalancing a portfolio of 20 stocks? Rebalancing is a very personal decision, and it's something I've written about on the site. I will try, if you actually Google when does it pay to be your own fund manager? You might find an article I wrote about this some time ago. Rebalancing is a lot to do with, and in fact, if I click this link actually into the chat room, it'd probably be easier. We put this together beginning of last year, and it's really about, partly was to look at the different, when should people invest in funds, when should people invest on their own. But rebalancing costs it depends on the size of your portfolio. It also depends on whether you're in a tax exempt account like a SIP or an ISA, where you don't have to deal, for example, in ISAs, AIM stocks do not have stamp duty. You've got those kind of costs to sort of think about. I'm hoping that we can eventually get all of this on the site almost as part of the product, so that you can calculate your rebalancing costs and figure out the time frame for rebalancing. Of course, if you've got a massive portfolio with no tax it's in a tax exempt portfolio, rebalancing will be very cheap, and the sort of the cost of rebalancing will not be very much. But if you've got a very small portfolio and you're dealing with sort of £15 a share or £10 a share trading costs, it's going to be much more expensive. So please don't make the mistake of following the guru screens and rebalancing things quarterly in any old account. Joel Greenblatt recommended a 1 year holding period for private investors in his book, The Little Book That Beats the Market. And for a lot of this kind of systems, and for a lot of people's portfolios, that's kind of more appropriate. Robert Haugen suggested buying a whole list of stocks and then every month rebalancing the worst out of it and buying the best of other rankings. So there's lots of different ways to sort of slice the onion. And really, it really does come. I can't, obviously, I'm not a financial advisor, and sometimes, and it's important that people seek some advice on this or talk to other people about their personal circumstance. We can only talk very, very generally. When will the StockRank Performance info be available to subscribers? Well, I was hoping I just made it available to you, but we will be trying to put it on the site as a product going forwards. I can't be. What I want to do is start building rebalancing into that portal, and just make sure that we've really got covered all the bases. So, for example, on those lists, we aren't including the ICAP shares, the ICAP security or the old Plus Markets shares. So, for example, Sprue Aegis, which is a stock that everybody has. Not everybody, but a lot of subscribers have been invested in and has done fantastically well since we first wrote about it at a share price of 90 just over a year ago. It's done brilliantly well, but obviously it was one of the top stock ranking stocks a year ago of 99, and now it's slipped to 73. So I think that's I'm going off the point, but the point was that the StockRank Performance might have been better than I just published because we are not including the ICAP Securities Exchange stocks in that list. So we've got more work to do on that portal, and we will be pushing it out later. How often do you need to trade? Again, I get that question a lot. That's entirely a personal decision. How can we use Stockopedia for maintaining a portfolio? Can you set up alerts on the stock ranks? Yes, good point. Can you set up alerts? Yes, indeed you can. If you hover over, actually on any stock, you'll see this button, Set Alert at the top. If you click that, you'll get this pop-up. And in this list, again, with any luck, if you scroll down, you'll see stock ranks. So if you wanted to sort of put an alert up for Sprue Aegis for when the stock rank, again, goes above 80, you just do that and you save the alert. And that will get saved into your alerts bucket. And here you can see it. You'll receive an email when that is breached. So that's how you would get alerts at the moment. We're hoping that we can eventually build a system so that people can get alerts when stocks come in and out of the top 10% of the market. Alex Namani, who has been writing and wrote an article on the site about the screening upgrades and downgrades, will be writing a column every fortnight about stocks that are moving in and out of the top 90% of stocks on the market. So that'll be something to keep looking out for. Excuse me if I do not answer everyone's questions, but we are sort of out of time. And I think that's pretty much it. One final question. Have we tested further back than starting from last year? As I said, we did it on US stocks. That was all that we could have available to us using a system available to a professional investor. And we haven't done this testing any further back than our live tracking from last year using the actual results. The most important thing to appreciate is, this has been a very good environment for the stock market. The last 5 years have been very good, and there's no guarantee that future returns will hold up. We haven't tested the system on UK stocks for the kind of drawdowns that might come available, that might happen. Obviously, there can be huge volatility in the stock market, so tread carefully. And if you are using these systems, just be aware that there have been hundreds of others on this call, and other people are using them. So be careful of any crowding in shares if you are buying stocks that have been ranking highly. So anyway, thanks a lot for listening, everybody. We will be putting this up on YouTube, and just checking if there's any more questions, but we will put it up on YouTube probably tomorrow, so you can play it back and pause it and have a little another dig around. Again, if anyone's still thinking of signing up, do use those codes, and I'll see you online and hopefully at events that we might be doing in future. Thanks a lot, and best of luck in your investing. Take care.